CommitToWealth.com. Creating a legacy by committing to real estate wealth.
Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. On today's show, we have Paul Moore. Paul is a serial entrepreneur and has been involved in various real estate asset classes, including multifamily, mobile home parks, self-storage, and development. He's the author of The Perfect Investment, host of the How to Lose Money podcast, and a frequent BiggerPockets contributor. He's the founder of Wellings Capital, and he was the guest on episode 29 as well. So, Paul, welcome to the show again.
Hey, Juan, great to see you.
Hey, it's a pleasure to have you on again. As I said, it was episode 29 when you were on last. You added a ton of value. You gave us a lot of information. I learned a ton, and I'm sure that my audience did as well. So it's just great to have you back again.
Hey, thanks. It's great to be here. And how's the weather down your way?
Here in Houston, we're doing pretty good. We're actually it was a little chilly this morning, and chilly for Houston. Go figure. But it's good right now. We're still good. Get into maybe May or something like that. Then it gets a little tougher. It's humid and hot. So
right.
So yeah, let's go ahead and get the show started, Paul, and tell us where you're calling us from. And then also tell us more about your background, because I know I just did high level, and I know you have a deep background. Just kind of give us some good highlights.
Well, I'm in Central Virginia near the Blue Ridge Mountains. We actually, I worked at Ford Motor Company for about 5 years. Then I started my own company. We sold the company to a publicly traded firm in the late 90s. And I moved to my family with 2 kids at the time. Now we have 4 to the Blue Ridge Mountains of Virginia. We've never had a good reason to leave. We don't have a convenient airport. It's about 2.5 hours to Raleigh, Durham, 3 hours to DC.
Wow.
But other than that, we love it here. I'm looking outside at a lake and a mountain behind it, and it's just a beautiful place to live. So yeah, it's been a long ride through all kinds of things. I called myself a serial entrepreneur over the years, and I would have put that on my business card, but now I'd be ashamed to have that on my business card, because serial entrepreneur means you're always in startup mode.
Mm-hmm.
And when I semi-retired, so to speak, from my job in Michigan, moved to the mountains here, we started a nonprofit organization, and I got really bored. I was about 35, and I was a high energy type A entrepreneur with very little to do. So I became, I think, probably the worst version of myself as a father and a husband. And I just felt kind of lost for a couple of years. So just while we're in our boredom, my buddy and I started flipping houses before the word flip was ever in the vocabulary of America. And we started buying and reselling these homes. It was fun. I painted a closet once, and I think they came behind me and repainted it. I was the finance guy, and I don't think I wasn't very good at that kind of stuff. So when I actually decided to build 7 homes, that was another mistake. We made money at like 6 of the 7, but it was just not really my thing. I did a subdivision, did a ground up multifamily / hotel / man camp in North Dakota. It was extremely profitable. Went from that to do a Hyatt hotel in North Dakota, depending on oil prices. And honestly, it was a big failure. And still the nicest Hyatt hotel, nicest Hyatt house, at least in the U.S., as far as I know, but not in a great location.
Nice. Mm-hmm.
And so I got really excited about commercial real estate, even though that wasn't such a great venture. And when I realized the power of commercial real estate, Juan, I decided, man, I would never have done anything else. I was in my 50s by then. I know I don't look a day over 40 probably, but I was in my 50s. If you guys are watching on YouTube, you know that's a lie. But
you're like 33. That's about right.
Yeah, right. But no, seriously, I really realized that, I wish I would have known in my 20s. And for those out there who at any age, if you're listening, please listen. If you don't catch anything else, please catch this next few minutes about the power of commercial real estate, because the value formula is so powerful, and I don't think it's well understood. I actually wrote a book about multifamily investing that, 3 years later is still selling well, but chapter 8 talked about the value formula, and I don't think I really understood how powerful it was even then when I wrote it. So If you want, we can chat about that a little bit.
Yeah, no, that's a very good point, because I think, there's a lot of guys that are in residential real estate, and I can understand why, right? Because there's not a lot of hurdles that you got to go through. It just seems more attainable, more achievable. You think of maybe a house, and it's easier. It just seems easier, right? We normally live in houses, so why not buy a house, right?
Right.
But yeah, tell us about that. Commercial real estate, to me, in my opinion, is far superior versus residential. Yeah. But give us your reasons.
Yeah, it's really true. So, I mean, Juan, if you were Chip and Joanna Gaines Jr. and you were able to take your house and pump $400,000 of improvements into it and make it the nicest $1 million house on the block, and all the other houses on your block were selling for $400,000, and you got $1 million total in this house, almost everybody who's listening knows you're not going to get $1 million out of that house, because residential real estate is based on the comps, the comparable properties. Commercial real estate is completely different. There's a value equation. You might want to write this down. The value equation in commercial real estate is value equals net operating income divided by cap rate. Now, the net operating income is the net income before any debt service. It's not including any debt service. And the cap rate is the capitalization rate, or the expected rate of return for that type of asset in that market at that time. And so the cap rate has historically, Juan, been running 7, 8, 9% for many decades. And now the norm is quite a bit lower than that, which means prices are quite a bit higher than that. They're running in the 5, 6, 7% range, and in some markets even 3 and 4%, meaning that investors are tolerating a much lower rate of return. Mm-hmm. Obviously, that means they're paying a much higher dollar amount for an asset. Mm-hmm. So the best way to explain is, I think, maybe using an example. So in commercial real estate, again, the value is the income divided by the cap rate. Let's say you were able to raise the numerator by $1, okay? Let's say you were able to raise the income on a property by $1 a month. That's by saving costs or maybe by adding revenue. And by adding $1 a month, that is, I'm really good at math, watch this, $12 a year, okay?
Yeah.
$12 a year. Now divide that $12 by the cap rate, and let's just say an average cap rate today is 6%. So you divide 12 by 0.06, that's $200. $1 increase to the bottom line a month, and you've got a $200 increase in asset value. But it's better than that, because to the investor, there's a leverage effect, because that's the value increase at the asset level. To the investor who's got, let's say, a 60% loan to value ratio on this, there's a 2.5x multiple effect. And so at the equity value level, it's not $200 increase, it's, so to speak, it's about a $500 increase at the equity level, all from generating $1 of additional income. It's very, very powerful, and that's without changing the cap rate. Now let's look at another example. Let's say you have a mobile home park, and let's talk about what would happen if you changed the cap rate. If you were able to buy a self-storage, a multifamily, or a mobile home park at a 7% cap rate, let's say you bought it from a mom and pop, and without doing anything else to the numerator, in other words, without changing the net income, you had a magical way to sell this to a REIT. Okay, now REITs and life insurance companies, institutional investors, are often willing to pay a much higher price for an asset because it's stabilized, it looks like a franchise, it might be part of a portfolio. Let's just say you did nothing to the income and you just were able to sell it to a REIT. Let's say you bought it at 7% and you sold it at a 5% cap rate. Well, that would be something like a 20, 25, maybe 30% increase in asset value just by finding a different seller. So it'd be sort of an arbitrage, if you will. Okay. Mm-hmm. Now, getting a 25% increase at the asset value, 25% appreciation is really powerful. But what is that? How does that affect the equity? Well, again, with leverage, there's like a 60% LTV loan. That's about a 2.5x impact at the equity level. And so that might be a 60 or 70% appreciation just from finding the right buyer. Now, the power is when you can increase the income and compress the cap rate both. And that's why people we invest with are getting these massive returns. They've got a formula. We've got a company we've invested with that's got a formula. They've done this 19 times where they've gone in, they've increased the numerator, they've compressed the denominator, and they've been able to, in about 3 years, give investors about 150 to 175% total return in about a 3-year window. And like I said, they've done this 19 times. So they're giving the investors a 42% IRR, or about a 50% more or less annual return by doing this formula. It's called forcing the appreciation. It's also called finding the right buyer. And so this is a very, very powerful strategy that can be used in any commercial real estate asset class. And the beauty of it is, that this is why the Forbes 400, most of the wealthiest people in the US invest in commercial real estate. The sad part of it is, historically, the average investor hasn't had access to this asset class. Now we do, because of crowdfunding, because of the internet, because there are funds out there who've opened up these wonderful large commercial deals to the more average accredited or even sometimes non-accredited investors. So that's the beauty, that's the power of commercial real estate investing, Juan.
I love it. You pretty much hit it on all different angles, and, you are right on. There is just so much upside to commercial real estate investing. So speaking of commercial real estate investing, you have focused a lot on multifamily, right? So I've noticed that you're starting to make a little shift here. Tell us what that shift is and why it is.
Yeah, I just did a talk at a Richmond, Virginia real estate investor meetup. It was called "Why is a Multifamily Author Not Investing in Multifamily, at least at the moment?" Now, technically, our funds are open to multifamily investments. We just aren't finding deals that make a lot of sense. And part of the reason, the reason, is that multifamily investing, by and large, is overheated right now. Now, there are syndicators, there are operators that are finding good deals. I can just tell you, our company wasn't finding great deals. And being the very conservative investors that we are, we've decided to, like I said, expand outside of multifamily now. But I think I've identified about 7 reasons that multifamily is overheated. Okay. And so one of them is 1031 exchange investors. So there's a record amount of 1031 exchange money running, that is exchanging out of their record sale prices. And they've got all this money, and they're willing to overpay. And Juan, you can understand why. You can understand why they'd rather overpay by, let's say, 10% than pay Uncle Sam 10 or 15 or 30%, especially in states like California that have a high capital gains rate on top of the federal rate. Mm-hmm. So the temptation for a 1031 exchange investor to overpay is real, and all the rest of us are competing with them. Okay. So number 2 is IRA investors. It's not a huge impact, but there's a record amount of self-directed IRA money being thrown into commercial real estate right now. Multifamily is a very popular venue for that money. And I don't know why, but it seems to me that self-directed IRA money is not as critically evaluated. The deals aren't as carefully or critically evaluated as people do with their regular cash. I'm not sure why, but it seems like people tend to overpay a little more and be less critical of the deal when they're dealing with self-directed IRA funds. Not in all cases, of course, but some seem to be. A third reason I think multifamily is overheated is international money. Now, international money would be money from places like China. My friend Ben is near Shanghai in China. He is a coordinator of commercial investors in China who want to invest in the US. And he literally said to me, he said, "I know many, many large investors in China who would be willing to tolerate a 0 cap rate, a 0% return in the US just to get their money out of the Chinese currency, the Chinese RMB, into renminbi, into the US dollar, because they feel like the relative loss in the Chinese currency compared to the relatively stable US dollar would allow them to make a profit just by having a zero return in commercial US dollars.
Wow. That's huge. That is crazy.
How can we compete with them, Juan?
There's no way. If you're okay with the 0% cap rate, then I don't know what to say. I mean, you're pretty much done. You're pretty much done.
There's
a lot of capital out there in China that's ready to get deployed. But not only China, there's a bunch of other countries that are
right. Mm-hmm. Well, there's a lot of countries out there like Israel, New Zealand, Australia, Europe, where the cap rates, the normal cap rates, like the New York City cap rate in the U.S., it might be 2.5%, 3.5%. And so for them, a 5 or 6 cap in the U.S. is a great deal. So international money is causing a big impact. I know of a multifamily deal near Houston where my friends were certain to get it. The LOI was, I think it was minutes from being accepted. And then a Chinese group swooped in and put $1 million hard without even seeing it and said, look, we're giving you $1 million hard deposit. If we don't like the asset when we get there, you keep the $1 million. Well, of course, the seller took that deal. And so international money is definitely playing a big role. Now, another issue is institutional money. Now, institutional money are like REITs, life insurance companies, these large investors. They used to be limited to the coast, like LA, San Francisco, Boston, New York, the North Coast of Chicago. But now they've come into places like Houston, Dallas, Kansas City, Lexington, Kentucky. They're competing with these smaller investors as they come to the middle of the country. They come into smaller assets. They come into older assets. They come into less stabilized assets. And we're all competing with REITs, not all of them in every case. But I mean, they are definitely driving the price of real estate on average to a higher level. They're compressing the cap rate because often they can accept a lower cap rate or a higher price. A fifth factor is tax reform. Do you know that in November of 2017, before tax reform, I think it was 75% of people said that they thought multifamily had already reached its peak and it was already softening. 2 or 3 months later, in January or February of 2018, after the Tax Reform Act, the same survey said that something like 50% of the people thought that multifamily still had a lot of room or some room to grow. It went from 80% thought it had reached its peak. I think it was a 70 or 80. Now only 50% thought it had peaked. And so it was a huge shift in just a few months. All I can explain is the Tax Reform Act injected new life into commercial real estate investing. And as we all know, multifamily has been the darling of commercial real estate for the last decade since the recession.
And
now I say, yeah.
So part of that number 5, the tax reform, as you mentioned, is the bonus depreciation, just accelerated depreciation, where a lot of people are willing to put in large amounts of capital and invest large amounts of capital into, an asset like multifamily to be able to offset, some of their income. And so that's part of the reason as well, so it wasn't as hot. It wasn't as sexy, November 2016, but now everybody's jumping in. That's just one reason among the other reasons you mentioned. Yeah, you're right.
Yeah. Yeah, right. I mean, that doesn't even go into opportunity zones. There are multifamily stuff that's in opportunity zones that's now getting new life as well. So
for sure.
So a sixth reason is the Nuru impact. Yep, I said Nuru. I didn't say new guru. I'm trying to coin this phrase, but it's not catching on. Maybe you can help, Juan. New gurus are people who weren't even around, and that's okay. They weren't okay. They weren't around in 2008, and that's okay to not be around. But a lot of them are telling people to go ahead and invest in multifamily, go ahead and overpay. They're saying it's different this time. We've heard that before. There's a book called "It's Different This Time," and it's talking about all the debacles over the years when people said, wait, it's different. You can go ahead and invest and overpay, and that actually gets me to my seventh category and the seventh reason that multifamily is probably overheated, and that's gurus who are actually wolves in sheep's clothing, and that is people who knowingly are telling investors to overpay so they can make a brokerage commission, an acquisition fee, an asset management fee, a split of the profits. Whether the investors make money or lose money, they're still going to make money. And so those are the type of people that I'm trying to hoping that your audience and my audience will steer clear of, because we don't need any more wolves in sheep's clothing telling us, to invest. I was actually at a conference recently, and a very famous multifamily investor syndicator actually got on stage, and he said, "Hey, just get into multifamily. It doesn't matter how much you have to pay. Go ahead and overpay. It's worth it to get in." Really? Does Warren Buffett think that way? Does Howard Marks think that way? The greatest of investors of all time say sell when people are talking that way, but he's saying buy. Well, a lot of people are following this guy, and I really wish him the best. I hope it continues to work out well for them. It has so far, but I don't know about the future, Juan. I'm really nervous.
Good point. Yeah, Warren Buffett's quote on that is, "Be fearful when others are greedy, and be greedy when others are fearful." Something like that. But you're right on. Mm-hmm, you're right on. That's exactly what it is. Mm-hmm. Okay, so these are 7 powerful reasons. I mean, let me just go through them real quick. You mentioned reason number 1 is the record number of 1031 exchanges that are willing to get out there and possibly overpay, and in a lot of cases they are overpaying, because they'd rather get into a deal versus give it to Uncle Sam. Number 2 is the record number of self-directed IRAs that are getting thrown into multifamily. Number 3, international capital. You mentioned China. Some of these investors are willing to take 0% on their capital, or 0% cap rates is what I meant to say rather. Number 4, institutional capital, REITs, insurance companies, those sorts. Number 5, the tax reform changed changing the taxes really changed how investors think and what they want to do with their capital. You're talking about opportunity zones. You're talking about bonus depreciation here. A lot of good tax savings there. And 6 and 7, I mean, what was the word you used? The new gurus. What was the word? New ruse. I mean, these guys are taking advantage of people and telling them it's the best thing since sliced bread. So, I would say that multifamily is, if you can find a great deal, that's a key. Find a great deal, then it can be very beneficial. But those are few and far between these days, and so it makes it very difficult. So let's kind of push on this. So if you're not so bullish on multifamily these days, then what are you bullish on, and what are you focusing on these days? Then.
Yeah, just to be really clear, Juan, if I had $1 million and I had to invest it for 100 years and I couldn't touch it for 100 years, I would invest in multifamily because I really am bullish on multifamily. The problem is millions of other people are as well, and I think it's just overheated. So just to be clear, I still love multifamily. I still think it is, one of the perfect investments out there, but
Perfect. Hey, now that he threw that one in there, you got to check out his book, The Perfect Investment. You can find it on Amazon. So I just want to say that for you, but because it's a good book, I think people should pick it up and read it. And but this is multifamily, right? So right. So what are you focusing on then?
So we've set up a fund that we've actually set up 2 funds: a growth fund, which is all about appreciation, and an income fund, which is all about income with appreciation being the cherry on the sundae. And we are investing in multifamily, self-storage, and mobile home parks. Now, we haven't found any multifamily that makes sense, like I said, but we are really excited about the different opportunities we found in self-storage and mobile home parks. In fact, if you like, I can tell you briefly why I love these asset classes.
Yeah, I mean, I know why. Tell my audience why, because they are very powerful. I've looked into them too. Tell them why. Go ahead.
Okay, so self-storage is a very large and very fragmented market. There are about 53,000 self-storage facilities in the U.S. That's about the same as Subway, McDonald's, and Starbucks combined. But about 35 to 40,000 are run by independent operators, and a lot of those are mom and pops. And they don't know how, or they don't care to drive value. When they built these, they said, if we build it, they will come. And they did. It was true. But that doesn't work anymore. This is an age where, people that have actual websites and Facebook pages. They're actually able to draw more traffic. And so we're looking to find self-storage assets that are in the path of growth, but that are run by mom and pops. And this is a perfect opportunity to add square feet, to add other income generating opportunities, adding U-Haul, adding late fees, admin fees, having a beautiful showroom, selling locks, boxes, tape, scissors, those kind of things. They're powerful ways to drive other income. And again, using the value formula, think about this. Adding U-Haul alone can add $3,000 or $4,000 a month to the bottom line. Now let's take $3,000 a month. That's $36,000 a year to the bottom line. Divide $36,000 a year by the 6% cap rate. And I don't have the exact number in my head, but I think that's like $500,000 or $600,000 in additional value to a self-storage facility. Now, for an asset that let's say cost $6 million, adding $600,000, you just added appreciation of 10% just by parking U-Haul trucks out front and renting them. But to the equity investor, let's say there's only $2 million in equity in that deal. $2 million, you just add 600,000. That is, what is that? That's like 33%, I think, 33% appreciation to the equity just by a policy and procedure change, just by adding U-Haul trucks. So it's very powerful. Wow. Now, self-storage is very sticky. I mean, the tenants are, at least, and that doesn't mean they wear Velcro suits either. I mean, these tenants are very unlikely to leave for a price increase. Think about it. If I was renting you an apartment, Juan, and I rented your $1,000 a month apartment, I raised your rent by 6%, you might leave for the extra $60 a month. That's $720 a year. But if I was renting you a self-storage unit for $100 a month and I raised it by 6%, you're probably not going to take a Saturday or vacation day, pack up a U-Haul to move your your treasures down the street just to save $6 a month. And besides, self-storage tenants, and I've been one in the past, always think I'm only going to be here another few months anyway, regardless of the truth. That's what they think. And so self-storage is very sticky, and it is a great business in great recessions. I mean, great recessions. In the Great Recession, people were downsizing from their 4,000 square foot home to say 2, or the 2,000 square foot home to an apartment, and they need a place to store their stuff. In boom times like now, they are filling up their Walmart carts or their Amazon carts, and guess what? They need a place to store their extra stuff. And so self-storage is a great asset class, and it's very recession resistant, but not quite as recession resistant as mobile home parks, because mobile home parks are also very sticky. The tenants are much more sticky, and I'll tell you why in a minute. But unlike self-storage and every other asset class, mobile home parks are actually shrinking in supply every year, while the demand is consistent or increasing, because we all know there's an affordable housing crisis. Well, the number of mobile home parks in the U.S. are documented shrinking every year. They're not going to be expanding again. And so it's the only asset class I know that has a shrinking supply, increasing demand, and the tenants are even more sticky. Now think about this. Let's say I took over a mobile home park and I really increased and wanted to improve it, and I was increasing the rent from, let's say, $300 a month to $330 a month. Okay? Now, that's a 10% increase. That's pretty stiff. But if you're a tenant there, are you really going to come up with $5,000 to move your mobile home park down the street to a lesser quality park to save $30 or $40 a month? Probably not. In fact, mobile home park operators I talk to say it virtually never happens. And if you have a double wide, that's $10,000 or $12,000 to move your mobile home down the street and risk damage and all the other things that come with that. And so self-storage and mobile home parks tenants are very, very sticky. Another thing we like about mobile home parks is the opportunities for ancillary income. Here's a big one. We recently invested, and this is just an example. I can't actually call it as a completed deal because it's not sold yet, but we invested in a mobile home park that will someday be refinanced or sold. And let's say the purchase price was around $5 million. Okay. So the loan on that was 60%. So that's 3 million. The equity in it's 2 million. Now keep those numbers in mind.
Mm-hmm.
Now the operator went in and said, we're going to clean this place up.
Mm-hmm.
Everybody who's got a third or fourth or fifth or sixth car in front of your mobile home or RV or a boat have to move it into this beautiful fenced in area that we're about to build. So they paved an acre of weeds and they put a nice fence around it. And they said, okay, you've got to move your third or fourth or whatever car and boat and RV, et cetera, in there. And then as soon as the area is cleaned up, they're going to actually advertise on Craigslist and make it available to the public to put, boat and RV storage. Now, when that 1 acre is filled up, they're going to be able to make $10,000 in additional revenue per month. Okay. Juan, it only costs them $100,000 to do it. So at $10,000 a month, first of all, the income's going to go up.
Yeah.
It's 120% annual return on investment once they're actually full. And it might take them a few years to get full, but 120% annual ROI. But wait till you hear this. Go back to the value equation. Remember, commercial real estate, the value is the net operating income divided by the cap rate. Okay. So $120,000 a year, $10,000 a month, $120,000 a year divided by a 0.06, 6% cap rate. That's $2 million in increased asset value. You got a $5 million asset just went up to $7 million. That sounds great, 40% increase. But think about this. What's the value to the equity investor? Remember, it was a 60% LTV loan, so there was only $2 million equity. That $2 million equity just went from $2 million to $4 million. It doubled, and that's just by one fairly straightforward change they made to the park. This is powerful. This is why commercial real estate is, in my opinion, one of the most powerful forces in the investment world. And so that's an example of how to do it in a mobile home park. There's many examples to add value in a self-storage and, of course, in multifamily as well. All three are recession resistant. We love all three, and we're investing in all three in our 2 funds.
Gotcha, man. That's some really, really good information that you gave there. Some really good examples as well. You did mention earlier that mobile home parks are becoming more and more, or I guess less and less out there, right? What's the reason behind that? What's the reason why they are starting to, I guess, become more distinct or more less of a number out there? What's the reason for that?
So first of all, it's very hard to get a new development of a mobile home park. People think, not in my backyard. They come out and they fight. They don't want a mobile home park. So that's the from the people point of view. If it's what happens is if there's a mobile home park that used to be on the edge of town and now the town has grown to expand around that, basically the developer might be in a situation where they want to develop a new apartment building. They might want to develop something else in the town. And the city council or the county commission or whatever will actually make a deal with them and say, look, we really want to get rid of that eyesore, that mobile home park. If you get rid of that, we will approve this other project. Or it might be a project that they want to do in place of the mobile home park. And so mobile home parks they're drying up. I mean, there's statistics I saw in Austin, Texas, and in Orlando, Florida, where the number of mobile home park pads is decreasing every year. But this is across the country. Now, there are a handful being built every year, but they're generally in rural areas, and they're places most of us wouldn't want to invest anyway. And so I don't want to quote the exact number, but I've heard there's a couple hundred going away every year and just a handful being built every year nationally.
Yeah, those are some pretty big numbers that, it just makes it that much more valuable. So if you can find yourself a good, solid opportunity in the mobile home park space, then you better jump on it because, like you said, the developers and, city, frankly, they don't find them as attractive as they do some of these nice retail developments. They'd rather have something like that or some of the Class A multifamily properties. That's really what they would rather have because they just look better. But as an investor, we like those mobile home park opportunities. They provide a lot of good cash flow, and that's really the thing about mobile home parks is the cash flow. There's
Right.
It's just a potential to have way more cash flow than on any particular multifamily deal. Can you talk about that? So can you give us an example of a typical mobile home park and the cash flow that it can provide?
Yeah. So we invest in mobile home parks in our income fund because we really do like the cash flow. They often cash flow at 5, 6, 7%. And, of course, by increasing the rent a little bit, by filling a couple more spaces that weren't full before, by maybe renting carports or sheds to the residents, which our operators do, by, adding the storage element, which I mentioned earlier, there's great ways to increase income. One thing that's powerful about mobile home parks, there's a couple of things. One is that Freddie Mac and Fannie Mae allowed 2 refinances of a mobile home park in the first 5 years with no penalty and a guaranteed locked-in interest rate, which was the original interest rate. And so one thing that's powerful about that is we in our income fund, the Wellings Income Fund, we really look for the opportunity to refinance and harvest lazy equity. And what I mean by that is if we have an investor who puts in, let's say, $50,000, in year 4, 5, and 6, we expect to refinance most of the mobile home parks in there, hand back the investor their $50,000 or most of it, and then they continue with the ownership in the fund out for a full 10 years. So that $50,000 is still growing and throwing off income, but now that $50,000 is also back in the investor's hand, and they can reinvest it somewhere else, starting an additional stream of income. It's very powerful. We call it harvesting lazy equity, and we love that. Another thing we love about mobile home parks real quick is that, you wouldn't think that the depreciation would be very strong on it because we all know you cannot depreciate land. Guess what? A mobile home park, Juan, is typically about 30% land, 35% land improvements like lighting, sidewalks, pavement, etc., and 35%, are you ready? Goodwill. And so 35 plus 35%, 70% of a mobile home park can be depreciated over 15-year straight line, not 39 years like typical commercial, not 27 and a half year like typical residential, 15-year straight line. That means 4.66% of income every year on a cash-owned deal can be covered by depreciation, meaning the investor has no taxes. They shouldn't, at least. But with leverage, again, you go 2.5x using our 60% loan to value example, 4.66% coverage times 2.5x. I believe that's 11.66% of income is covered by depreciation for all 15 years, if my example is right. Powerful, which means you not only get this great income stream, you can expect that you might not have to pay much, if any, taxes along the way.
So you mentioned 70% is what we can use here in this example. You also mentioned goodwill. Can you explain that a little bit more? What do you mean by goodwill?
Yeah, there's an accounting term, or accounting term called goodwill, which means when you buy a business, you're buying, like if you bought Nike. You'd be buying the factories, you'd be buying all the equipment, you'd be buying all the marketing, the branding, all that stuff, but you'd also be buying their name, the goodwill of that swoosh, and so that is worth something, and that's actually, believe it or not, depreciable.
Okay, gotcha. That's very interesting. Now, the other thing about that is you mentioned 15 years. Is it typical to use bonus depreciation in the mobile home park space as well?
We checked into that, and the bonus depreciation is a powerful thing with the tax reform. And I'll tell you where it does work. It does work in any portable stuff that's like personal property. So, for example, if we bring a whole bunch of sheds in and we lease them to the tenants, My understanding is it's not attached. It's not, true real estate. Therefore, it can come under bonus depreciation, which my understanding is, I'm not a tax professional, but my understanding is that can be fully depreciated in 1 year. Powerful. And that loss carry forward.
Gotcha. Well, yeah. So that's just another reason to get into the mobile home park space. The self-storage space, but also the mobile home park space, which I personally think that those are two powerful asset classes in today's market. I think that regardless of what market cycle you're in, I think they're powerful. But because multifamily is so heated, as you mentioned many times before, it just makes you think about it and really try to move over to self-storage and mobile home park space.
Right.
Very powerful.
Very true.
So Paul, it is time for our nuggets of wealth, and let's go ahead and get those questions started. Question number one: what is a good tool, source, or platform that you use almost daily that can also help others?
So I talked about Hubspot before, and I really like Hubspot because it's free. There's a lot of very expensive upgrades that come with Hubspot, and I think those are probably worthwhile as well. I really love Hubspot. Another thing, though, is I'm actually using what's called a 411, and a 411 is made famous by Gary Keller of Keller Williams. And his book, The One Thing, he talks about this, and I'm using a 411, which is a basically prioritization tool that you just create yourself with an Excel. It really helps guide my priorities each and every day.
Got it. Okay, so that's a 411 prioritization tool by Gary Keller. The idea from The One Thing. What is the top advice or tip that you give to someone who is wanting to make this transition from multifamily into mobile home parks or self-storage, sort of like yourself?
Yeah, about a year ago when we started really getting serious about expanding from just multifamily into these other asset classes, we realized on paper, as many of your listeners who just listen know now, hey, here's a formula that works. Here's this value formula. Here's how we can increase the value. Let's go do it. Well, I realized, I hadn't done it myself. And I thought, Juan, I don't know if I feel comfortable taking $5, $10, $20 million from investors to do something that I haven't done myself. And so I decided it would be best for us to partner with a team, with a company who's been around for years or, hopefully decades through several recessions. And that's what we decide to do. And that's what I'd recommend your listeners do. And that would be to find a great operator, a great team who's been at it a long time, and invest with or partner with or go to work with them to learn the business from the ground up.
Okay. Very good advice. Okay. You have a book yourself called The Perfect Investment. I think I mentioned that earlier, but I think, people should definitely pick up a copy. What other book are you currently reading?
I'm reading Principles by Ray Dalio. And Ray Dalio is the founder of the most successful hedge fund ever. And it's a most amazing book about his principles for wealth, not only for wealth generation, but for life and for business. And I'm trying to apply those things to our company.
Okay, gotcha. Good recommendation there for sure for anybody listening. Where do you see your business and company in the next 5 years?
What's that again?
Where do you see your business and company in the next 5 years?
Yeah, I see us continuing to open up a growth fund and an income fund, probably annually to, basically to allow us to put a new group of investors in these wonderful investment opportunities that we are vetting. We are constantly vetting operators. We're looking at their deals. We're traveling around. We've been in Minneapolis, Florida, Tennessee, South Carolina, just in the last several weeks, meeting with operators, looking at deals. We plan to continue to do that on behalf of our investors.
Okay, gotcha. And at the end of your life, how do you want to be remembered?
That's a great question. I don't know if we talked about human trafficking before, but I tell you, human trafficking is a horror. And it is happening all around the world. It's happening all around us. Did you know if you took the record profits from Apple, Starbucks, Nike, and GM, If you took their record profits and you doubled that number, that's the approximate annual revenue they believe is being generated by human trafficking worldwide. It's slavery. It's a civil right that's been ripped away from tens of millions. And so my goal is to do everything I can to raise awareness of this and to raise capital, to raise money to fight this. And so I want to be remembered as somebody who had an excellent business, who did a great job making a lot of money for our investors, but also used the money that I have access to personally to fight this great evil.
Got it. To make a difference in the world, man. I love that answer. Great. Where can Commit to Wealth Nation go to contact you and find out more about you and your company, Wellings Capital?
Yeah, you can go to Wellings, Wellings. That's Wellings Capital, CAPITAL.com. That would be a great place to connect. We've got a contact form there, and we'd love to chat with you.
Okay. Wellingscapital.com. Well, Paul, it was a pleasure to have you on. I really do appreciate your time. You did definitely give us a lot of light on the self-storage and mobile home park space, something that we're not necessarily accustomed to speaking about here on the show. But I think it's a very couple of different, very powerful asset classes that people should really explore and look into. So with that said, I do wish you continued success.
All right. Hey, Juan, thank you so much. Thanks for your show. I appreciate it. It was great to be on here again.
Hey, thank you so much.
CommitToWealth.com, creating a legacy by committing to real estate wealth.